Good morning or good afternoon, wherever you are. We'll just wait another minute or two as we wait for a few people to join us. All right, why don't we get underway? Firstly, as I said, good morning to those that are in the Northern Hemisphere and part of the United Kingdom, and good afternoon and good evening for those towards Australia or in Australia. We've got a terrific list of registrations for this webinar, which is a sign of the interest in this particular topic. As an introduction, my name's Richard Basil-Jones. I'm the CEO for the Australia-UK Chamber of Commerce, based here in London and within Australia House. The Chamber, as you probably know or may not know, but we're a member organisation with about 150 companies. And those companies typically have interests in both the United Kingdom and Australia. And our role is to create a connection and provide information and collaboration where we can. And hosting events like this one is exactly our mode of operation. And as I said, I think there's some real interest in this particular webinar. So there's going to be three topics covered: mortgage, property and tax. We're going to have three experts speaking with us. We'll have Martin Jeng and co-founder and mortgage broker from Odin Mortgage speaking to us. We'll have Brad Purcell, who's the National Head of Acquisitions for Milk Chocolate. And lastly, we'll have Bradley Murphy, the founder and Australian tax lawyer for Murphy Tax. Just a couple of quick housekeeping activities. One, there will be time allocated at the very end for Q&A. And to facilitate that process, there is a little button at the top of your screen within Teams that says Q&A. Please feel free to enter your questions as we work throughout this webinar. Essentially, the timing will be around 45 minutes of content, and we'll allow around 10-15 minutes for questions. You'll also be advised that we will send a copy, a video link and a copy of this webinar, recording of this webinar, and we'll also provide the contact details for each of our three speakers who you see on screen currently. So if you miss something or you need to contact any of these speakers, we'll make sure that's possible through a follow-up email in the next 24 hours. My duties are finished there. I'll come back on at the Q&A time, but I think we're in for a really informative session, and I'm personally really interested to hear from each of the speakers. So thank you and enjoy the webinar.
All right, thanks, Rich. I think I'm first up, so I'll share my slides. And maybe you guys can just give me a quick yes if you can see the slides. I think it should be okay.
Yes.
Yeah, awesome. Thanks, Rich. So I hope everyone's nice and warm. Rich told me that it was quite cold in the UK last week, so hopefully everyone's snuggled up at work. All right, so my name's Martin. I'm one of the head mortgage brokers at Odin Mortgage, and we predominantly help expats based overseas with their Australian mortgage matters. And we serve expats in the UK, in the US, Singapore, Hong Kong, pretty much globally. And our main focus is on Australian mortgages. So today I'll start with an Australian lending overview, talk about what's happening in the market, and then I will move to some tips that you can use as an Australian expat while you're overseas. And then we'll answer one of the questions that I seem to get asked a lot, which is whether we should buy now while we're overseas as an expat or when we get home. Then if time permits, I'll go into some case studies. All right, so let's get started. So the Australian lending overview. So what's been happening? The RBA held the cash rate steady at 4.35% in December. So as you can see from this graph, the interest rates have just been climbing non-stop for the past year and a half. And that has really put a damper on property prices. However, if interest rates are to remain kind of stable and even go down over the next couple of quarters or year, you can expect maybe a rebound in the property prices, but I'll let Brad talk to that. The average interest rate for investors at the moment is around 6.24%. So that's actually quite high relative to 2020 and 2021, where we were recommending our clients to fix their rates. However, at the moment, variable rates are probably the way to go if you want to take advantage of potentially decreasing rates over the next 2 to 3 years. The RBA has kept rates stable because I guess they want to allow people some flexibility and some breathing space over the Christmas period. So you should be able to enjoy a temporary pause in the rate hikes, at least over the next 1 to 2 months. So what does this mean for house prices? So the textbook answer is when interest rates go up, prices usually come down for housing. But if you look at the data, you'll see that over the past 30 years, property prices have just been going up consistently. This may just be an Australian trend. However, I think one of the reasons why property prices continue to maintain their purchasing power is because it's just something that can't get inflated away like the money supply in the US and in Australia. So the reality is that nobody really knows what's going to happen to house prices. Will the RBA continue to raise rates above 5%? Will there be hyperinflation? Will there be a recession? It's really hard to tell. So I wouldn't be too focused on waiting for a drop and waiting for prices to correct, because at least over the past year and a half, interest rates have been going up. So if you're waiting for a drop, that ship has probably already sailed. So now I'm moving to some tips on whether or not you should use an expat mortgage broker and what are the key reasons why you should use them. So a lot of times people ask me, can I get financing myself? Well, the quick answer is yes, you could get financing yourself. You could research 30 banks yourself, manage the application and the solicitors and the agents yourself, fill in the application form, collect the documents, go back and forth with all the banks, witness everything yourself, execute contracts yourself, and then at the end of the day, you'll end up getting rejected and pulling your own hair out. Alternatively, what you can do is use someone like Odin Mortgage. So as an Australian expat mortgage broker, we will do a preliminary assessment for you based on your financials before we submit an application. We'll guide you through the entire process and we'll manage all the parties involved. And essentially we do this all for free because the banks pay us. So quick answer is yes, you can do it yourself, but we highly recommend using a broker. For those of you who do want to pull your own hair out and try to go it on yourself, go it alone, tip number one that I'll give you is research which banks will apply Australian tax rates versus local tax rates. And then essentially you just do a calculation to see which one is more favorable to your situation. The second tip is research which banks will lend 80% LPR and which banks will only do 70% LPR for expats, because not always will banks lend 80% or 90% like they do for Australian residents. And then tip number three is research which policies are relevant to your situation. So for example, some banks, after you get a mortgage with them, they won't allow you to refinance. So you're essentially stuck at that bank. Research which banks will allow you to use bonuses, 1 year or 2 years. Research which banks will allow you to do an equity cash out in the future. Which banks only lend to those working at multinational companies. So a whole host of policies that you should do some research before you submit an application. Otherwise, you'll spend around 2 to 4 weeks submitting an application because the banks will tell you everything is possible only until the application actually gets assessed by the credit team. Will they come back and tell you, oh, actually, we can't do this. But if you use someone like an expat mortgage broker, because we do this day in and day out, we know exactly which banks will lend to which policies. So definitely come speak to us. Tip number two is how to avoid settlement headaches when you're buying a property. And the answer is get a pre-approval. So if you don't take away anything from my presentation today, just take away this one point. It's to get a pre-approval. And why should you get a pre-approval? The benefits of getting a pre-approval include being able to confirm how much you can borrow before you go to that auction or before you sign on the dotted line. Because unlike in Australia, you can easily rock up to a bank and get an application approved within 2 to 3 days. However, as an expat, that process can take between 2 to 4 weeks. So definitely get a pre-approval first to confirm how much you can borrow. It mitigates against a loss of deposit and a void of contract. So if you sign on the line, you're pretty much in a contract and you would have to commit on this. If you cannot commit on the deal, then you would lose your deposit, which is usually around 10% of the purchase price. Pre-approval also gives you negotiating power. The reason for that is because sellers want certainty on obviously the purchaser. So with the pre-approval and that letter, you can actually go in and negotiate a little bit harder. Pre-approvals are valid for 3 to 6 months, so you can focus on property hunting. So rather than try to juggle 2 processes at the same time, what you want to do is get a pre-approval first. That will last 3 to 6 months, and then you can focus on property hunting using your friends and family or buyer's agents like Brad from Milk Chocolate. And the final thing is it costs nothing at all because the banks pay. It costs nothing at all because you don't have to pay the brokers, and bank fees are only payable upon settlement. So banks will have a fee, mortgage brokers don't, but the bank fees are only payable if you settle on a loan. So the cost of getting a pre-approval is actually only the time effort that you have to spend. So what are the steps in getting a pre-approval? So here I've got 3 to 6 weeks for an expat. In Australia, this process probably only takes a couple of days or a week because it's all simple and there's a lot of open banking, which means all the bank accounts in Australia are linked directly to the open banking system. However, as an expat, you actually have to download all your documents and upload them. So step 1, come to our website, fill in an online assessment, and then you will get an email from our brokers who will send you lender options and confirm the loan structure. Step 3 is to upload your documents for us to check that everything you've told us actually matches what we need to send to the bank, and we then submit an application to the bank for a review. Step 5 and step 6 is your loan gets pre-approved, and then with the help of a buyer's agent, you can then start your property search. And then finally, you sign the contract of sale and the loan agreements, and then you rely on the agents, the solicitors, and the brokers to help you close out the on the purchase. Tip number 3, how to cash out equity from existing properties to use as a down payment. So for those of you who already have a property in Australia, purchased 5-10 years ago, it's probably built up a nice little equity buffer, meaning that the property has not only appreciated in price, but you've been paying down your existing mortgage. So what you can do is you can tap into that equity, and it's essentially a great strategy to build up that property portfolio. So how does it actually work? So before how it works, maybe let's talk about the pros and cons. So the pros are it unlocks capital gains on existing properties, like I said. It minimizes the cash contribution from current savings. So instead of having to fork out 200K for a $1 million purchase, you probably have to fork out a little bit less. You could also potentially restructure current unfavorable mortgages and get on lower rates. So a lot of times our clients come to us if they haven't looked at their mortgage for a while. They're probably on a rate of currently like 7%, which is about 1% higher than the market rate. And that's because banks aren't incentivized to reduce your interest rate. They're just going to keep you on a higher interest rate and not tell you about it. So come speak to a broker and we can help you refinance. You also get some cashback incentives to cover the switching costs. It's just a bank bonus that they usually give. However, there are cons associated with cashing out as well. So you've got to make sure you understand what you're actually doing when you cash out. You're essentially borrowing more, so you have to pay more interest. There will be larger repayments, and you could potentially become a bit over leveraged. So definitely use our calculators on our website to see if you can actually handle the repayments. So let's go through an example. We're running a little bit short on time, so I'll pass over to Brad after this slide, and then I'll wrap it up there from the mortgage side of things. So this case study is a purchase funded by a cash out. So for those of you who have a property, this would be relevant for you. For those of you who aren't in the property market, think of this as a strategy to build up your investment property portfolio. So let's say you made a purchase at 600K and you got an 80% LVR mortgage. It would essentially mean you borrow 480K and you'd have to top up about 120K of equity to purchase your first property. You wait a few years, in this scenario about 7 years, and then you do a valuation on your property. The purchase price has gone from 600K to a market value of 800K. you've paid down 80K of your mortgage. So now you're on a 50% LVR, right? So then what do? What you do is you take out an additional equity loan of 240K, or essentially you're cashing out to top that mortgage back up to about 80% LVR. So new valuation of 800K and taking out a new mortgage of around 240K to get the 80% LVR means you have around 240K of cash. So then what does that mean? It means if you wanted to buy a $1 million purchase, you would then get another 800K loan, add on 50K for stamp duty, but now you have 240K of cash from the equity cash out. So the funds required from you to purchase the second investment property would only be about a $10,000 cash outlay. So that is the strategy to get a second investment property using a cash out strategy. So I won't cover this question because it's actually a bit stretched on time. So I'll move actually straight to the summary. Wrapping up, yeah. So to wrap up, use an expat mortgage broker if you're based overseas, get a pre-approval and leverage on your expat status and earning power, and review your existing mortgages and properties for an equity release. All right, with that, I'll pass back over to Brad.
Thanks, Martin. And thank you to Richard for the introduction. I'm just going to share my screen as well. And Martin, if you can just give me a holler, mate, to confirm that you can see that screen okay?
Yeah, I can see it.
Perfect. So guys, as per the introduction, my name is Brad Purcell and I am the National Head of Acquisitions at Milk Chocolate Property. And what we do at Milk Chocolate is that we help Australians and Australian expats plan, buy, build and manage Australian property. So the purpose of my presentation this evening is to provide some insights as to what we've seen within the Australian property market space and what we're likely to potentially see moving into 2024 and some key takeaways with regards to that. The advice that I am going to offer is general in nature, and we certainly always encourage our clients to seek specialist tax and accounting advice before transitioning into these types of activities. But one of the unique positions about my role at Milk Chocolate is that I am effectively the conduit between our data analytics team and all of the on-the-ground purchasing that we undertake across the country. So we're buying houses in every state and territory in Australia at present, with the exception of the Northern Territory. And that creates a very unique perspective because data tells us one thing, but it is often about sort of a 3-month lag between what the data indicates versus what's happening on the ground. So the unique exposure that we have is we get to also witness the behaviour and the activity of all of the general population and how they're interacting with Australian property at any point in time to really help inform the direction that we're going to take our clients and the recommendations that we make. So with regards to the current Australian property market trends, I am going to apologise in advance because I feel like my presentation may be a little bit data rich. I'll try and keep this as lively as possible. And I'm also got to be really conscious of time as well. So if you've been following the Australian property market fairly closely, you would have recently potentially identified that CoreLogic announced that we have undertaken what is being labelled as a V-shaped recovery. And that effectively means since the commencement of price correction, the period of price correction, which I'll get into a little bit more detail shortly, the combined Australian capital property values decreased by 7.5%. And at the end of November, we have completely recovered all of those losses and we are back into plus 0.3%, which effectively means that values today, and this is the key point, for combined property values are higher than effectively they ever have before. So we're higher than the most recent peak. But to really understand that, it's probably more important to have a look at the key moments in time that a lot of our market commentators and economists have been referring to. And so to break that down for you, effectively, the key 3 moments in time that everybody's been focusing on is what's being labelled as the onset of COVID to previous peak. So more recently, that was called the recent peak. However, we've now succeeded that peak. So the onset of COVID is effectively from when COVID started through to the point in time where the marketplace, each individual capital city reached its peak price and what date that took place, through to the recent trough, which is effectively from that period of correction when the interest rate journey began, where we've subsequently had 13 consecutive interest rate rises. And from the bottom of that section of the marketplace through to current, and in some circumstances that's a new peak, and I'll sort of expand on that in a little bit of detail in a second. So if we first have a look at what's been happening in Australian real estate effectively since the onset of COVID through to that recent peak, there was a period of time obviously where we had emergency level interest rates. Australians were locked inside their houses. We weren't travelling. We were saving bucket loads of money. And Australians' favourite pastime is to interact with property, and that's exactly what we did. There was significant amounts of intrastate migration. There was what is labelled as an owner-occupier-led recovery. So the most dominant force within that marketplace were homeowners looking to upgrade their own properties. And what this graph is designed to demonstrate is the very consistent performance of every capital city across the country. Every capital city was doing the exact same thing. The only variation was the percentage of price increase and some timing. But you can see some of the consistency with regards to Brisbane from the onset of COVID through to May 2022, its values increased by 45.3%. So it was the best performing capital city, followed by Hobart, Adelaide at 41.1% in August, unfortunately the worst performing city, and this sounds silly to say because its values increased by 15.8% in effectively 2 years less, was Melbourne, primarily because it was the most locked down city on the planet, and real estate was heavily impacted during that period of time. So why that's an interesting consideration is because from that period of the onset of COVID through to that market peak, property prices basically experienced a record period of growth, and every capital city was following the same trajectory. What becomes a little bit more interesting though is when we start to look at that period of correction, once that interest rate journey commenced, where we started to see those interest rate rises, it effectively created a period of uncertainty. And uncertainty for buyers within the Australian real estate space creates a holding behaviour. So it's been estimated that up to 50% of the buying public, after about the third or fourth interest rate rise, decided to put their search journey on hold based on the uncertainty of where those interest rates were going to end up. And that subsequently created a market correction cycle where we started to see values decrease, and we started to hear all of these horror stories with regards to this fixed interest rate cliff and that property prices were going to have a significant crash. It ultimately was nowhere near as significant, but one of the more interesting considerations that's come out of this, which is a bit of a pointer sign to what we can expect to see in 2024, is the re-emergence or the return of multi-speed conditions. And that is what this graph is sort of designed to show you, is that every capital city and the localized considerations within that capital city started to create a different level of performance. So for example, we now have 3 capital cities that have prices significantly above the most recent peak or the previous peak, and that is Perth, Adelaide and Brisbane. So they did experience some fairly significant price correction, but they have subsequently recovered all of those price corrections. Sydney is just about to do the same. We're still currently, according to the data, sitting at 0.5% below our recent peak. I say I'm sitting in Sydney at the moment. Melbourne has still got a little bit of work to do, but then we look at locations like Hobart, for example, where its median values are still 11% below where we were in the previous peak. And the reason why I wanted to highlight that is because that cyclical nature of the Australian real estate space is very traditional. That is what we generally tend to see, is that capital cities are being influenced by localized factors, which is something that a lot of people became immune to, particularly since the onset of COVID, and the very the emotional buying behaviour and the emotional pricing that was taking place during that period of time. So where that effectively leads us to at this point is that we do have different capital cities doing different things. For example, Perth, we're still seeing prices increasing at a greater speed. So if conscious of time, so I'm going to pull out just a couple of examples. the October's performance for Perth saw median rates increase by 1.6%, and in November it increased by 1.9%. But in contrast, Sydney's rate of growth, so that our prices are still increasing, but the rate of growth is starting to slow. And for example, in Darwin and Hobart, we're now seeing prices start to decline, and also in Melbourne for the first time in a little while as well. And why that's really important is I wanted to sort of look at that as a bit of a pointer sign. If we have a look at the individual localized considerations for each of those marketplaces and apply some of those to the overall property market nationally, it may give us some pointer signs about what to look forward to in 2024. That was a very nicely timed segue, even if I do admit that myself. So a couple of key market drivers that we need to keep our eye on for 2024. What this slide is designed to show you is that the considerations on the left are going to be placing upward pressure on property prices. The consideration on the right is going to be placing downward pressure on property prices. It is a fairly complex environment at the moment within Australian property because there are quite a few push and pull factors with regards to price. So I'm not going to break these into detail, but one of the key considerations is the fact that our new housing supply is significantly below the targets that our federal government had set, but also the requirements that we have as a country. The cost of construction and all of those key considerations has basically put new home construction at a significant disadvantage, and as a result, we're not building enough houses for people to live in. The side effect of that is that the established housing market sees upward pressure on pricing. The consideration of relaxed lending. So there are conversations taking place, given that we're potentially at the peak or close to the peak of our interest rate journey, that the regulations that APRA introduced in 2021 to add a 3% serviceability buffer is potentially looking to be reduced, which is only going to enhance people's borrowing capacity. Population growth. So we are actively recruiting skilled migrants to call Australia home. Those people are going to need places to live. Historically, Sydney and Melbourne are the biggest beneficiaries of that. And then evidence, and this is something that Martin was touching on in his presentation, evidence of potential rate reduction. One of the key takeaways, if you're only going to take one thing away from my presentation this evening, is that the general buying behaviour in Australia is influenced by social proof. So it takes a long time, or it takes generally a lot of evidence to shift the entire market paradigm. However, the one thing that is likely going to have a significant impact, and a fairly quick impact, is the consideration that, or even the conversation just surrounding the fact that interest rates are going to start to be reduced. That is going to start to bring a lot of people who are still in any form of holding pattern or still have any form of uncertainty back into the marketplace. And one key observation to share here is that real estate is like any other commodity. It is supply and demand driven. At present, we have had historically low levels of stock, and we've had significant levels of demand because as we see those start to shift, and a bit of an equilibrium between supply and demand potentially speaks about some positive buying environments to start next year. Some of the downward pressure on pricing, though, is the fact that houses are still incredibly unaffordable for the majority of Australians. The risk of inflation becoming more difficult to control, therefore influencing interest rate decisions, either to increase rates or delay any cuts in rates. Rising unemployment, as our economic conditions are controlled, the likelihood of more unemployment causing difficulties with people to get access to money. And the biggest thing for me that I wanted to almost wrap up on, because I'm at 10 minutes now, is what I'm calling the established housing flood. And that is that a lot of vendors have been waiting for that social proof, so sellers, to know that now is the time to sell. And a lot of those people haven't made that step yet. However, if we look at some of the early indication trends that we've like the early indicators for 2024, that bottom right-hand corner speaks about healthy agent listing pipelines for Q1 2024, and effectively almost every real estate agent in this country, in every state and territory, has a significant pipeline of new listings that they're going to be bringing to the market at some point in Q1 in 2024. And that effectively is a a significant indication that that supply and demand curve, or that supply and demand ratio, may start to transition to the point where buyers can be a little bit more selective again, and the opportunity to have some more leverage from a purchasing perspective will be increased, because at present there is significant amount of competition moving forward. So the ultimate summary for me, and I'm conscious I've potentially skipped over a few things, but always happy to assist with any questions that you have, is just be ready. And my feedback mirrors a lot of what Martin was talking about, particularly with your pre-approval, but also your strategy. So a couple of key notes with regards to strategy is, as a potential investor, there's a consideration to look at purely high yielding assets and what would be considered to be investor grade stock. One of the key things that we encourage our clients to look at Milk Chocolate is the fact that you need to be buying a property that appeals to the broadest potential spectrum from a real estate fundamentals perspective. The easiest way I summarize this to our clients is, you want to buy a house that you're going to be selling to an owner-occupier, because owner-occupiers make emotionally driven purchasing decisions, whereas investors traditionally always make commercially driven purchasing decisions. And people who buy with their heart generally pay significant premiums, particularly when they're put into competition. So focusing on the type of assets that you can resell to homeowners effectively assists you in looking at the capital growth aspect of your investment, because one thing a lot of investors don't factor in, even though it's important if they're just purely looking at yield, if you cut out capital growth, your overall or total return is significantly influenced. And so you want to always ensure that you've got a property that is in a quality location that has options as well. So the ability to manipulate that asset as part of your portfolio moving forward to create lots of flexibility, because your circumstances may well change, but those opportunities carry with that property and always assisting, contributing to its value. And there's a couple of other things like character and a few of those. But if there's any interest that you have with finding more about that, this is the type of service that we offer to our clients. We assist you in creating a plan. We assist you in acquiring those assets, undertaking any manufacturing of value or renovations with our construction team, and effectively managing that asset on your behalf as part of your portfolio. And we're building some technology in the background to assist with that, which is something we could potentially let people know about a little bit more. And so if you do have any questions, my colleague's detail, Michael Cleary, is on that slide, and we can make those details available to you. And we're more than happy to offer one-on-one sessions for any more detailed questions that you have with regards to the property space, but also how investing in Australia can be achieved for your personal circumstances as well. So with that, I think I've taken about 15 minutes, so I will pass over to the other Brad so that he can take you through some of the key considerations with regards to your tax positions.
Thank you, Brad and Martin, for the respective presentations. Certainly very helpful. I'm just going to share my screen. If somebody could please just give me the okay that you can see these.
I think you're sharing the wrong screen, Brad.
Ah. How is that? Any better?
I'm not sure if it's just me, but I think it's still the
we can
team
see
screen.
Team screen.
Yeah. Okay.
I think you may be able to drag the PowerPoint onto the screen you're just sharing.
Yeah. Okay. How's that? Any luck there?
Yeah, perfect.
Yeah, that's it.
Sorry about that, everyone. And yeah, and thanks again to Brad and Martin for those great presentations on the property market. So yeah, a bit about Murphy Tax Lawyers and Advisors. We're a specialised Australian international tax firm and expat tax firm located in Melbourne and Sydney. We provide international tax advice and also prepare expat tax returns for Australians. We do specialise in Australian and UK tax, and also recently opened our office in the UK. So we have a real integrated approach in looking at both the Australian and UK systems and giving our tax advice. I think it's really important and really key to look at both the Australian and UK side and giving advice to our clients. You know, what may be effective in one country, for example, in Australia, is often not effective in the UK, and certainly vice versa. So really important to get integrated and joint advice in looking at international tax planning. A bit of background about myself. I'm an Australian tax lawyer and previously worked with several Big Four firms in Australia and also worked in the UK. So looking at what we'll cover today, there are obviously a lot of issues to consider with tax advice and tax planning. So we'll briefly touch on some of the key points as it relates to Australian and UK tax. I think the first point to point out is we're seeing a real focus at the moment with revenue authorities in Australia and in the UK through the ATO and HMRC through data matching through AI. So in particularly money transfers coming into Australia or the UK, and also immigration records in both countries. So there's certainly an increased compliance focus at the moment through HMRC and the ATO. So just be aware of that when you're looking at your tax matters at the moment. We'll look at tax residency in Australia and the UK and the Australian-UK tax treaty and how that works. We'll look at employment income, how is that taxed, and how the tax treaty works for employment income and any employee share income. We'll look at the tax treatment of property in Australia and the UK. Australian superannuation and the UK pension planning is always a popular subject. And finally, we'll look at some tax efficient investments in Australia and the UK. So first off, an overview of the Australian and UK tax system. I think it's really important for Australians living in the UK to be aware of the tax implications of ceasing Australian residency and commencing UK residency. Yeah, as mentioned, some of the issues would be how's my employment income tax and what is the impact on my investments in terms of superannuation, property, shares, and the use of trust and company vehicles in Australia and the UK. I mean, as a general comment, what might be tax efficient in Australia is generally not tax efficient in the UK and vice versa. It's also really important to consider your time frame as an expat and when you intend to come back to Australia. For those looking to go for a 2-year short-term secondment, the focus will be on employment income and temporary employment relief and how to really, I guess, enjoy your time there for that 2-year period, doing some travel and work, but also you utilize those concessions, which we'll speak about in a moment. If it's that medium 5-year time frame, how to efficiently invest in property in Australia or the UK and shares, as compared to that 15-year long-term horizon, where the focus is really on long-term retirement planning, perhaps downsizing property, looking at estate planning or passing on wealth to your kids and family, and also how these deemed domicile rules will impact long-term UK residents too. So the first really important point is tax residency. It does impact a number of tax outcomes and almost drives all tax outcomes. As an overall comment, if you're going to the UK for more than 2 years and have left Australia for more than 2 years, you would normally be considered a non-resident of Australia from that date of departure. It's not always the case, but a broad rule of thumb. And UK tax residency would normally commence on the date of your arrival in the UK. If you're going to the UK for a short-term basis on a short-term temporary secondment or move under 2 years, you would likely be a dual tax resident of both the UK and Australia. And that's where the tax treaty would allocate residency based on a tiebreaker test. And that tiebreaker test really looks at where you have a permanent accommodation available to you for that period. And the tiebreaker treaty is often overlooked as well by many tax accountants, I find. So, if you are looking at, going on a short-term basis, the tax treaty would normally allocate taxing rights to the UK on your employment income. So bear that in mind, and not Australia. One really important point too is these proposed new tax laws in residency that has been announced by Treasury in Australia. the so-called 45-day rule, as everyone has been referring to it. And this proposed rule was saying that effectively spending 45 days a year in Australia would deem you to be tax resident for that year. It's only a draft rule. At this point in time, there's been no draft law or no date announced as to when these rules may commence. And I suspect there will be hopefully a bit of common sense apply where that 45-day rule is pushed back to a longer time frame. And there should be some exemptions under the tax treaty with the UK as well, but certainly watch that rule carefully. So if we look at employment income and employee share income, how is that taxed? Look, normally if you're moving to the UK and doing your work from the UK, you would just pay tax in the UK on that income and not Australia. If you are looking to work remotely for an Australian employer in the UK, just make sure you do get some advice around that. You really don't want to be in a situation where you've got you've got Australian pay-as-you-go being applied and you're on Australian payroll. That can get a bit messy in terms of double taxation. So certainly get some advice in terms of how that can be perhaps restructured if you are looking to work remotely in the UK for your Australian employer. A really big concession that's available, which is often overlooked, I find, for secondees moving to the UK. If you're in the UK on a short-term secondment for under 2 years, there is this concession, which is known as temporary workplace relief. And effectively, you can deduct all your costs of travel and rent in that period for 2 years, which can be a very significant tax saving. So if we look at the tax treatment of Australian investment income while based in the UK, first point, just remember your Australian tax filing obligations to report that income. It's certainly very common that expats leave Australia and forget to report that to the ATO. So any Australian source income still must be reported back to the tax office in Australia on an Australian tax return. And that broadly includes any rental income from Australian property, which is taxed at 32.5% on the net rental income. Rental losses can be carried forward indefinitely to offset future income. The other component is Australian dividend income. So effectively only the unfranked dividends are taxed. The fully franked dividends are not taxable to a non-resident. And finally, Australian bank interest, which is subject to a 10% tax. And that's the one we find, I think a lot of people do miss, that if they've got cash in the savings account in Australia, it is still subject to a 10% tax rate. The other big important watch out is this exit tax that applies when you do become a non-resident of Australia. That capital gains exit tax event applies to all assets, but not Australian property. So really shares, crypto, any private investments you may have. You can either pay that tax when you leave Australia based on the gain when you leave Australia, or you can defer it. And luckily with the UK treaty, it's quite favourable if you defer that exit tax, and any subsequent capital gain is taxable only in the UK and not Australia. And generally speaking, the UK rates of capital gain tax are quite favourable compared to Australia. So not always a bad outcome. But paying that exit tax can also be quite advantageous, especially if there's a loss when you leave Australia, which you can use to carry forward against future gains. Or if there's no gain when you leave Australia, you look to pay that charge when leaving Australia. If you look at the UK tax treatment of Australian source income, there are some certainly advantages for non-domiciled expats in the UK. And effectively, most Australians are not born in the UK would be classified as non-domiciled individuals in the UK. And effectively, that means that if you don't remit any foreign income into the UK, so transfer that investment income into the UK, you will not pay tax in the UK on that income. That's called the remittance basis of taxation. It applies automatically on the first £2,000 of foreign income. Otherwise, you must elect to claim it. And effectively, you can have it free for the first 7 years. After year 7, there is a charge to pay it if you've got significant foreign income. But always best to get advice around that. It's always a complex area. The other really important point for Australian expats living in the UK, particularly long-term expats in the UK, is the domicile status. So effectively, there's 2 categories of UK domicile. Really, one is if you're born in the UK, you have a UK domicile of origin. The other one would be if you're a long-term expat in the UK, so spent 15 out of the past 20 years living in the UK, you'd be what we call deemed domiciled for UK tax purposes. And that means effectively that you're subject to UK inheritance tax on your global estate. And also you become deemed domiciled for income tax purposes too, which does certainly likely increase your UK tax exposure at that point. You can break that deemed domicile status by leaving Australia for 6 years for income tax purposes and 4 years for inheritance tax purposes. But certainly just make sure you consider that if you're going to stay in the UK for the long term. So I think the most important point from this presentation, which I think I'll find clients get caught up on or trip up on, would be the loss of the Australian main residence exemption on Australian property. So the Australian main residence exemption, which basically exempts the sale of your main home if you live in it while in Australia, is not available anymore to non-residents of Australia. So you must be an Australian tax resident at that time to claim that exemption. So certainly watch out for that one. You do have the option of renting out your property for 6 years and retaining the full exemption, but really important that you must be an Australian tax resident when you actually sell the property to benefit from that exemption. So certainly, give that some thought if you're looking to sell a property or leave Australia with a property. I think if we look at the investment side of investment property and how that's taxed, look, as an overall comment, normally non-residents of Australia are subject to a higher tax burden on Australian investment properties through higher rates of capital gains tax, higher rental income, and higher land tax burdens. So really important to get the structure right in respect of a new property you're looking to buy. We see it's very much common Australian expats still buying Australian property, certainly a very, very popular asset class, as Martin and Brad explained before. So I think certainly very much on the cards, but just make sure you get the structuring right. And some of the key, I guess, things to be aware of is the loss of the 50% discount for the period of non-residency on the investment property. The rental income is still taxable in Australia. You can, of course, deduct the interest on that, but there's tax at 32.5% from $1 on that rental income. So certainly consider making a concession or super contribution to help lower that rental tax. So if you do have a positively geared Australian rental property, certainly make sure you're thinking about making a contribution to your Aussie super, which can help lower that tax burden quite significantly. And as mentioned before, rental losses can be carried forward indefinitely on Australian property to offset any future income in Australia. Just quickly, I know I've gone over time, so apologies about that. In terms of Australian super planning and UK pensions, so obviously a very, very popular topic and a very broad topic, so certainly make sure, again, you get advice. But I think a really key point for expats in the UK to consider is if you have any Australian investment income, think about making that pre-tax concessional contribution to your Australian super. The limit is $27,500 per year, and that's really going to save you a fair bit of tax and also get money into the super environment if you're looking to come back to Australia. If you don't utilize that $27,000 limit on a year-by-year basis, you can bring forward that limit over a 5-year period. So certainly, if you don't use that cap, you can certainly utilize it when you come back to Australia. You probably have up to $125,000, $130,000 you can put in pre-tax into your Australian super. So give that some thought. The other big one is looking at how a UK pension can be transferred to Australia when you do come back to Australia. So first point would be that a UK pension is normally locked up until age 55 due to the strict withdrawal limits in the UK. So I think really think about it as being locked up until age 55, at which point you do have the option generally to either transfer it to an Australian super fund or take out a cash withdrawal or a pension once you're back in Australia. And there are certainly some significant tax savings and benefits to having that UK pension transferred to an Australian super fund, in that you would generally pay quite a low rate of Australian tax of 15% on any growth that's accrued on it since you've been back in Australia. But I think more importantly, it would get you out of UK tax on that withdrawal. Normally a UK withdrawal from a UK pension is subject to UK tax over and above the first 25%. But when you do look to transfer it to Australia, you could normally obtain a nil code from HMRC to have that without tax in the UK, which is certainly something to think about. In terms of the, I guess, costs or points to look out in doing so, just be aware of the Australian superannuation cap limits around that. There's effectively a $330,000 3-year cap around what you can get into super on the transfer. And also the cost of financial advice in doing so can be quite significant. And if you're looking at a lump sum cash withdrawal, that can normally be done in the first 6 months of moving to Australia with no tax in Australia. So certainly a good option to consider. You can normally withdraw your UK pension tax-free in Australia in the first 6 months. If it's after that initial 6-month period, then you'll just be paying Australian tax on the growth of the UK pension after you move back to Australia. There can still be quite a good outcome depending on your circumstances. Excuse me. Looking at other investments and shares in the UK and Australia, an ISA account is obviously a very common tax planning vehicle in the UK, which is essentially known as an individual savings account. Basically, the annual limit on that is $20,000 each year you can put into the UK ISA. The gains and the income can accrue tax-free in that, and withdrawals can be made tax-free in the UK. Just be aware that on the return to Australia, Australia would tax the growth of that ISA as a capital gains event. So just make sure you're aware that when you come back to Australia, it will lose its effective tax-free status in the UK. And the other good one too is shares, in that once you leave the UK tax system, you will not pay UK tax on any share sales. And also there's a rebasing of those shares when you come back to Australia. So effectively any tax is confined to the growth of those shares after you've moved back to Australia. So certainly can be quite effective if you've got a share portfolio and looking to move back to Australia. Yeah, well, thank you. That is all I had. Please feel free to give me an email or give me a call. Email address is there, info@murphytax.com.au. And yeah, thank you for listening, and feel free to contact me with any questions. And I'll throw it back over to Richard.
Thanks, Brad. And just to remind everyone, we have made a recording of this presentation, and we will be sending a copy of the link to the recording, and importantly, the contact details of each of the 3 speakers that you've heard from today. Really seriously informative session. It's a tough game out there in that property market, and it's very helpful to know that there's obviously some experts that can guide people and help people through that process, and particularly with the tax advice as well. We do have just a question, and it's for you, Brad, on the tax side that came through. I'm not sure whether you can see that in the chat area as opposed to Q&A. It's, does the 6-year main residence exemption start from the time that you rent the house out and move to the UK, or from when you bought the flat?
Yeah, fantastic question, Richard. So it would start from the time the property is first rented. So effectively, that 6-year period would start from the date the property is first rented. And you can also restart that 6-year period. So if you move back into that property within that 6-year period, you get a further 6 years after that time. So yeah, so really important to consider that 6-year rule when you're managing your Australian main residence. Also, and the other point too would be that when you do rent the property for the first time, you're actually getting a market value rebasing of the cost basis at that time. So make sure when you do rent the property for the first time, you get a valuation done at that time, because that normally gives a better outcome, because you can have a higher cost basis for the property as well. But the overarching real key point there is that you must be an Australian tax resident when you sell that property to get the exemption. So I think any planning should involve just making sure you're back in Australia when you sell the property in that tax year.
Thanks, Brad. Are there any other questions at all? Look, I have no doubt that there'll be a number of people following up with some questions individually. Just let me just go quickly. There's just something in the Q&A. Bear with me for a second as I find the question.
Brad,
again, another one for you.
I'll ask you a question. Oh, sorry, there's one for.
Yeah, it's a tax question for Brad again. Do you recommend using a testamentary trust if inheriting an Australian property, in brackets, to give time to relocate to Australia to be resident again? What to consider when doing this?
Yeah, look, that's a fantastic question. Certainly, most Australian wills in the States would have a testamentary trust as an option under the will anyway. So if you haven't got one in there, I would recommend making sure you do have an option for a testamentary trust to be in your will. And normally the benefit of that would be to have shares rather than passing directly to a non-resident beneficiary from an Australian estate. They can be parked in that trust and distributed to an Australian resident beneficiary at the right time. So normally we see the use of a trust in that context, avoiding CGT on shares passing to a non-resident. In terms of property, it's a good question. Normally no, and normally you don't need to, because normally with a main residence, it can pass down without tax and you can manage it that way. So normally if, say it's part of an estate and it was the main home of the person that passed, then the person that inherits that property would have 2 years to still sell that property with no tax at all in Australia. And if it was sold after that 2-year period, tax would only apply on any growth that has accrued after that period. So to answer the question, I think quickly, we don't see it in the context of property, but definitely in shares. Yep.
Martin, you were going to make a comment, so certainly you've got a couple of minutes left if you'd like to.
Oh, no, I was just going to ask Brad, what he thinks of the property market with regards to apartments versus houses, while you were looking for some other questions, Richard.
Sure.
Confirming that was for me and not for tax advice, for apartments.
Yeah.
You can both have a crack.
Yeah. But look, traditionally, leaning back into that concept of sort of the real estate fundamentals, one of the key aspects to that is the irreplaceable or unique nature of the asset that you're purchasing. So apartments can often look like a tempting option because the entry price or the barrier to entry is lower and your yield can sometimes be higher. However, you're also purchasing sometimes within a building that may have 150 of the exact same option. There are examples, particularly off the plan type of apartments, where historically people have run into some trouble because, especially purchasing off the plan, you're buying a promise. Once that promise is created, the marketplace doesn't respond to the same standard. So, look, every circumstance is different. However, traditionally, if our clients have a budget that allows them to get into a freestanding asset, which you obviously don't have strata fees and you have overall control over the property, particularly with things like options for adding additional floor space, etc. Freestanding houses historically where we would recommend, and an easy litmus test for that is comparing the capital growth performance of freestanding houses versus units in each capital city. Historically, houses significantly outperform units over the last 40 years from a capital growth perspective.
Yeah. Just a quick question for Martin, perhaps as well. I know it's always an issue with Australian expats getting obviously a loan as an expat if you're looking to buy Australian property. But do you have any tips in terms of, if they need to lodge an Australian tax return to show income, perhaps to get that mortgaging? I know when expats come back to Australia for a period of time, especially if they're on foreign payroll or have foreign income, it can be quite hard to get a mortgage in Australia. Do you have any tips on how to navigate that period when they come back to Australia?
How to navigate the period of getting a mortgage when they come back to Australia?
Yeah.
Yeah, well, I think the way banks assess income and mortgages are pretty much the same, whether you're overseas or in Australia. So really what they're looking at is just your liabilities and also your income and expenses. So if you're overseas and you pick up any liabilities like credit cards or other mortgages, that's always going to affect how much you can borrow when you're back in Australia. Now, some banks will allow you to use your foreign income. So let's say UK as an example. If you have UK rental income, some banks will allow you to use that to offset the mortgage. However, some banks will actually disregard your UK income and only take your UK mortgage. So what you really want to do is you want to go to a bank that allows you to use the income to offset the mortgage, as opposed to a bank that only takes the liability, which is just a bit silly.
Thank you. Look, gents, we'll wrap it up, and to the 50 or so people that joined us in this webinar, thank you very much. It was seriously incredibly informative. We will provide the follow-up information, obviously. But again, thank you to our speakers and thank you to all those people that registered and joined us. So good morning to those in the UK and good night to those in down under.
Thanks,
All right, thanks, Rich.
Thanks, Richard.
Thank you very much.
Cheers,
Bye.
guys.
Bye.